Good day, everybody, and welcome to 2017. My name is Jack Davis, and I'm running the Chamber of Merchants. Some of you are familiar with the posts we've been doing online, and we've had a fantastic response. So thank you, everybody, for your support and for your participation and for just your general feedback. I hope that it's been something of an educational experience for you. I thought I'd do a video instead of a written report, simply because it's a little bit more interactive, at least for me. At the same time, it's getting a little bit boring writing out essays. I mean, I went to university, but it's not like I wanted to stay in university after leaving university. So I thought I'd give this a go. Please give us your feedback. Let us know, if this is something that is helpful to you. We'll be going through a couple of charts. We're going through a little bit of a few economic indicators and whatnot. So it's not like I've prepared a presentation. It's pretty much everything off the cuff. I'm going to be looking at what, I'm expecting to happen on Monday on the ASX for the gold miners, but of course you don't need to be trading the ASX to be benefiting from this video. Now, I don't charge a fee, I don't have a subscription per se, so this is pretty much just me sharing what I'm thinking, what I'm seeing, and hopefully it can be of some benefit to you. But very importantly, a small disclaimer: I'm not a financial advisor, so if you look at all our posts, you'll see that I have this disclaimer. I am not a financial advisor. Your wealth is at risk. Seek professional advice and do your own research. I am simply a trader that has put his own wealth at risk. Any shared information and perspectives are for educational purposes. So let me really just zoom up on that in case you don't get the message. There it is. Okay, so anything that you do is your own problem. I'm just hoping that what I share is of some benefit to you so that you can learn to think better. I love this guy. All right, so where do we start? Firstly, let's look at the economic indicators that came through last night. Now, interestingly, I'm actually getting a little bit keen on shorting some crude stocks. We're not quite there yet, but I think that crude stocks are starting to run out of steam. If you look at what happened, the crude oil inventories came in fantastically at minus 7 million barrels, I believe it is. Okay, so that is so much more than expected. Yay, let's all invest in crude oil. Let's all keep on operating as if everything's okay in the economy. The only problem is that over here, the distillates stocks rose. Instead of 1 million, it rose to 10 million. So the all-important crude oil inventories indicator is sending us a good message, saying that, well, they expected 2 million barrels, minus 2 million barrels, but instead they were minus 7 million. But when we're looking over here at the distillate stocks, we've got 10 million instead of 1 million. Gasoline inventories, we've got 8 million instead of 1 million. So does that sound like an economy that's doing very well? No, of course not. It sounds terrible. So to me, regardless of any OPEC meetings or anything like that, I really think that a shorting opportunity is coming up on crude companies. So I'm sorry if you own crude, but that's what I think, and that's what I'm going to be doing at some stage. So what do I think is worth shorting? Well, you know what? I don't think that I should be discussing that right now, because I don't want to give the crude owners or stockholders a heart attack. So I think I'll do that in another post. But it's safe to say that there are a couple that I've got my eye on, and I think that it would be a slow and steady grind. It's not going to be a drop. I believe that crude producers in Australia are going to be suffering from a weaker exchange rate. Right now, the US dollar is obviously a little bit stronger, so go figure. It rallied, and I'll be going into that in a in a couple of minutes or a couple of seconds. But I think that the crude inventory really shows us that the crude companies are going to come under pressure, and the rallies that they've been enjoying, that's all going to come to an end. So let's carry on and actually look at the economic indicators which affect my portfolio, which is gold and silver. So last night there was a huge sell-off in gold miners. I say huge, but in fact they only lost the gains that they made on Thursday. So the gains that they had throughout leading up to Thursday, that's still intact, but the gains that were made on Thursday were given back on Friday and some, and then it came back to where it opened on Thursday. Now that's probably due to tax. In the USA and in Canada, you've got tax. The reporting period is from January to December, whereas in Australia it's from it's from July till June. So we wouldn't have that tax issue, but of course we've got something called sentiment. So what drives share prices? It's sentiment. You can tell me how amazing gold is and that it's the only store of value. You can tell me how great crude is because we all use crude, but where does volatility come from? What makes a share sell off? What makes a share rally? It's from sentiment. So what drives sentiment? Many things. It's the global picture. It's the news. It's whether it's had a strong rally. People want to take profit. People are people, and especially now in January, gold is practically the best performing asset of 2017. So Friday last night, the gold miners came off of a rally, but they recouped. So let's have a look at what happened. So economically speaking, the indicators I was talking about all came back terribly. I mean, this is so disappointing. The US dollar should just have fallen apart. And I really do think it is going to fall apart, because all these indicators, pretty much except for those two, all those indicators pretty much show us that the Fed is not going to be able to raise rates 3 times in 2017. That's absolutely ridiculous. They're simply saying it for credibility's sake, to make people think that the Obama administration has done a great job with the economy. But of course, who wouldn't look great when you borrow $17 trillion? I mean, give me $17 trillion and I would look like I'm doing really well, except I'll be poorer than anyone on earth because I owe $17 trillion. And that's exactly what's happening to the USA. All right, so we got average weekly hours, which came in disappointing. We got non-farm payrolls. Now remember, the non-farm payrolls and the unemployment rate came in as it was last time. But the non-farm payrolls, when that disappoints, the market usually falls over itself and no one can sell or get out quick enough, right? Because the Fed is saying, okay, let's raise interest rates, but at the same time, you've got non-farm payrolls disappointing by a huge number. Fair enough, the last one was revised up from 178, but that'll probably get revised down too. Now remember, when we look at the history, a lot of this is based on assumptions. A lot of it is... apologies. I need to pause my ad blocker. Alright, as you can see, I'm not going to put a lot of effort into this. I'm not going to go editing videos and stuff like that. I don't have time. Alright, so looking back at the non-farm payrolls, you can see that these numbers change because they're based on assumptions. So currently we've got the 156, and now they're saying that the last one, instead of 178, it was actually 204,000. But here you can see this 161,000 actually became 142,000. So who knows how this will get revised? Will go down, will go up, but regardless, it's disappointing. You can see that between here and there you've lost 20,000. Between here and there you've put on 30,000. Between here and there you've lost 20,000. So it is a bit of a mixed bag, but overall I would say it's pretty disappointing, and the dollar should not be rallying based on that. In fact, the dollar should be selling off, because if the Fed wanted to raise rates, they could have done it previously. But now you got numbers coming through that are disappointing. So remember, we only raised rates once in 2016. Now the Fed's saying raise rates 3 times, and we're starting off the year like that. So that's it's not going to happen. They're not going to raise rates 3 times. And remember, the 3 rate hikes were baked into the US dollar already. So once the 3 rate hikes turns to 2 rate hikes in the mind of the market, it's going to it needs to sell off, which it already has. But now, given the most recent data, for some reason the US dollar actually rallied. But I don't think that the US dollar is rallying because of the economic data. I think the US dollar is rallying because the powers that be are pushing that US dollar as high as they can before selling it off every time. I'll show you a quick example of that. So if we look at the DXY, which is the US dollar index, I want to show you the 15-minute chart. I just want to show you how absolutely crazy this is, okay? So what we've got is we've got the US dollar that it rallies, and then it opens up lower. Then everybody ends up buying it. But then we've got offloading again. Then it gaps down because the 3 interest rates are not going to happen. And then people buy it again. Then it has selling pressure. So what we've got is we've got this constant selling of the US dollar. The trend is down. We're simply looking at, look at this. The US dollar has completely dropped out of this zone here, where it was since the 19th of December. Up, down, up, down, up, down, up, down. Failed to retain this trading box. Down, up again. Tested that box. It failed to hold. Went down. Now what it's doing is it's coming up against some resistance, but I doubt that the US dollar is going to be heading back up higher than that. I think what we're going to see is a steady sell-off, obviously with surprises along the way, but honestly, given the economic data that we started off in 2017 with, I just don't think that the US dollar has got enough power in it to rally. So why did it bounce off of here? Well, we bounced off of a very strong support zone over here. I'll fix it up for you. So there we go. So we've got that support zone over here. Really, it's like that. And what happened is we tested that price box, bounced out of it, came back up. But I don't think that we've got the stamina in the US dollar to make it back into this channel. I think what's going to happen is we're going to sort of work off of this trend line, and then we're going to work back into this box, and we might bounce around, which obviously means we're going to be enjoying a higher gold price, and then at some stage it's going to lose the plot and break through over here. Once it breaks through, it's got a little bit of support, test again, and it'll go down. This isn't over a day period, so don't expect this to happen tomorrow. This is months, okay? So we're talking about this could happen, I don't know. It's not good to make time predictions, but we're looking at somewhere around middle to end of January. I'd expect this dollar to start dropping down as Trump comes into the office and so forth. But of course, there are things that could happen. If a Japanese disaster happens, I don't know if if it will. There's always a possibility, and the probability varies. But if the yen, for instance, weakens heavily, which is actually what happened here with the US dollar, then you would find it's going to rally. So don't expect the bad economic data to simply make a downward trend for the US dollar, that economic indicators are bad, so now the US dollar just has to drop out of the sky. That's not how this happens. It's going to go down, it's going to go up, it's going to test, it's going to go up, it's going to go down, it's going to do its normal trading and all the way down. And so I believe it's down. So while other people might say that the US dollar is going to rally even further, I really don't see that happening. If you look at the trading boxes, you can see it clearly lacked the strength to stay in here. When I say it, I mean the people who are trading it, the funds, the banks. They don't expect it to stay in here, so what do? They're using these opportunities to load off to people who, the media tells them that the US dollar is rallying. Okay, so that's enough about that. Let's just go back to the economic indicators. You can see that the non-farm payrolls were disappointing. The private non-farm payrolls were also disappointing. The trade balance isn't looking good, so GDP is not going to look good for the USA. Unemployment rate stays the same. So now look at this. Factory orders, minus 2.4% as opposed to minus 2.2% expected. And remember, last time it was, 2.8, which was revised slightly upwards. But so you're looking at minus 2.4% factory orders. So just take a step back and think about this. If we're getting fewer factory orders, is this the kind of environment that the Fed should be raising rates in? We're so highly levered up. We're so badly in debt. When I say we, I'm talking about the US economy, even though I'm not there. But we're so badly in debt when we've got these economic indicators which are not fantastic. They're disappointing. And this is coming to the end. This is the final report, I believe, from the Obama administration. So is this the kind of environment that we expect interest rates to go up? So we've got all these bad numbers, but we're going to jack up rates. Why? Oh, because apparently we've got inflation on its way. Now, admittedly, we do have inflation showing up in the, in the PMI data. We've got inflation in gasoline and crude showing up. This is all going to filter in, and of course we've got the inflation that's coming through, or the cost push inflation coming through from higher bond yields. So if you look at the bond yield rate, you can see that also rose a little bit last night, and what that means is that gold is again under pressure, which we know it is. Gold dropped down to 1172 instead of 1180 something where it was. Now the bond yields increase the cost of borrowing, they increase the cost of debt, and the banks pass these costs onto the consumers like you and me. So with all these costs coming through, we get inflation, but most of it's cost push inflation. It's not demand pull inflation. Remember, when you got demand pull inflation, what it means is that there's a greater demand, so everybody raises their prices because they can't keep up with demand. You want to make more money, so you increase your prices. But what's happening here is we've got cost push inflation, which in fact means that costs are going up, but we're not seeing the economic growth. Costs are going up, but we're not seeing an increase in employment. Costs are going up, but we're not seeing an increase in factory orders. So what's happening? This is the nightmare for any economist, and that is stagflation. So if we're in fact heading into stagflation, that's bad news. Good news for gold, bad news for everything else and everyone else, because what it means is you've got a stagnating economy. It's not growing. You get higher and higher unemployment, which you won't see right now, but the unemployment, which is at 4.7%, that mostly consists of jobs in the waitering industry. industries. I mean, if you look at the articles from Zero Edge, where is it? Mainly it was from nurses, waiters, and waste cleaners. Now remember, I take nothing away from nurses or waiters or waste cleaners, but remember, GDP should be a reflection of productivity. And if unemployment is simply coming down because you're getting more waiters, and remember, more nurses, the nurses are part of the healthcare industry, which is part of Obamacare, so it's not like that's actually a boon for the economy. Who's paying for that? The taxpayer is paying for that, okay? And then waste cleaners, well, we all want waste cleaners, and I'm not going to have a go at them, all right? So they're fine. All right, so I think I've covered the economic indicators, and I've covered it in a lot more detail than typing it out in an essay form. I've got to tell you, my fingers sometimes just want to kill me. It gets a bit boring sometimes, so that's why I'm doing this. I would really like to cover more ground, and hopefully it's of use to you. So now, gold. Let's have a quick look. What is happening with gold? All right. So this is the 1 hour chart. I'll change over to the I'll change over to the day chart. Okay. Okay. So what's happening now? All right. So gold has, last year January, it made a bottom, and it rallied, it gave back all its gains, and everybody's still screaming for a lower low. So they're screaming for somewhere around 1,000, something like that. But what we see here is characteristic of a bull market turnaround. So what we've got is, if this is in fact a low, then it's a higher low than that one. That means that we can start charting like this. Okay, so that means that the next high should be higher. So you're looking at about, the next high should be around, 1450. Some people are saying 1433. But honestly, I can tell you what I think is going to happen in time to come. I can't tell you exactly when. But if we finally do get to 1430, I don't think that we're going to be selling off on 1430, because once we break through 1377, this 1380 mark where we topped for the Brexit vote, once we break through there, there's going to be a recognition phase which is going to occur in the market, which means that suddenly people realize that this is a bull market. Because remember, some people are expecting this, okay, so hitting up there and then coming back down. I think most people are not actually even expecting that. Most people are expecting it topping around about here. Let me show you. Okay. Most people are expecting a high of around about 1,300, if that. I know some people are saying that around about 1,200, and then they think it's going to come down. But then I don't see what the reason was for this. Why did we make a higher low, only to bounce off of a very small resistance and head lower there? We should have put in a lower low over there. All right. Perhaps we can get a lower low, but I don't see that happening, especially not with the economic data. Remember, everything that I'm chatting about on the Chamber of Merchants is about looking at the situation, looking at the economy, okay, and adding that to trading. There's no point in just charting it out. You have to look at what's happening in the world, what's happening around you. I mean, Bitcoin just rallied to above 1,100. It did sell off to, as you can see, $840. I did recently do a post on, time to sell out of Bitcoin. Of course, it rallied further than that. And like I said, a lot of traders know which direction is the right direction. It's just about the timing. And, I don't have a crystal ball. I can't say that Bitcoin is going to top today, but at the same time, I did speak about it, and it looks like the air is coming out of Bitcoin, and you can refer back to my previous post. I think it was let's have a look, just to bring up the chart. Okay, time to exit Bitcoin. So I know I'm jumping onto Bitcoin, but basically we are over here already. Okay, so this is an old chart. It doesn't show that we rallied up to there. Wow, these things are pretty annoying. But yeah, we're sitting around about 850 right now. So will it come down further? I think so. I think that we'll be seeing a regression down to the mean, perhaps even an undercut like that, which can take it down to 700. Now I saw I saw this article being quoted on Zero Hedge, I think it was, or Reddit, one of the two. And a lot of comments were getting thrown at the poster saying that it just sounds like some youngster, talking about the demise of Bitcoin. But at the same time, here we are. We're sitting at 8. What are we sitting at? 836. So I wasn't wrong. Here we are at 836. We're already down there. So an updated chart would show you that it came down all the way there. All right. We know that Bitcoin was rallying because of the Chinese capital controls and people trying to get their funds out and whatnot. Okay. Enough on Bitcoin. Back to gold. So here we are. So is there anything wrong with that red candle here? Okay, let's just zoom up on it. So gold came up onto 1184 and pulled back. No, of course there's nothing wrong with that. I don't see a problem with one red candle. There's a red candle, there's a red candle, there's a red candle. If you look at the last rally, there's plenty of red candles. Look at that. Red, 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 red. Of course, red candle means that there's negative volume. Okay? And that's profit taking, that's uncertainty in gold and that sort of thing. Right now, I think this is because of tax reasons. Because if I think a lot of people wanted to sell to take profit, and if you sold after January 1st, any tax benefit that Trump would enact in his presidency for this year would actually apply to you as long as you sold after January the 1st. So there's the tax. There's also the thing of, it did hit up against a small resistance, which is here, 1184, around about there. What was the high of the day? 1185. Okay. And I think a lot of people panic and they sell because they think, well, that's it, gold is coming back down, they're just trying to get out, so they take their profit and they go. I don't see this changing. I think that we need to enter back into this channel. Okay? At least we need to test it. And that channel is the, 1197, 1200 channel. So if this is a bear market, then what you would see happen is gold would test this channel, and it has to test this channel. It's just common, for any asset, for any commodity that's getting traded, for anything that you're trading, it tests resistance zones. So if we're in a bear market, then it would test this, get rejected, and it would move down. Okay? So what you would find, what I expect to happen, because I believe that gold is in a bull market, as you see here. This is a low, this is a higher low, therefore I'm expecting higher highs. But if in fact we're in a bull market, what it means is it's going to hit there. Now, two things could happen. It could power through, okay, so you could get a very strong rally like that one there, okay. And what could happen is you could get a retest of this box. Okay, so after a rally like that, you usually get a profit-taking event. Okay, because the big boys are not dumb. they're smart, they take their money and then they do it all over again. Okay. The second thing that could happen is, and this is what I'm more into this camp, I think that what we'll get is we'll get a test of 1200, and then usually if it gets rejected, everybody assumes, yep, bull market, a bear market, and they're going to short it all the way down. At least in their imaginations, that's what they're going to do. I think that's the perfect ploy to get people on the wrong side. So a rejection of 1200, everybody gets short, and we're just going to hit there, and I think we're going to get a powering through there. Okay. So on gold, that's over a couple of weeks. So that would take us to, if we went up there, so if we were to take a breather and went up there, went there, then I would expect that only maybe by the end of the month after Trump, somewhere around there. Now, something I did not count on was how dry your throat gets when you're talking instead of typing. There's always some kind of issue.